There is a setup forming in the silver market right now that the people paid to explain these things to you have not mentioned once. Not on Bloomberg, not on CNBC, not in the morning research notes that land in institutional inboxes before the New York Open. And the reason they have not mentioned it is not because the data is hidden. The data is entirely public. It is sitting in warehouse reports, in lease rate disclosures, in mining company filings, in the Silver Institute's own published surveys. The reason they have not mentioned it is because explaining it honestly requires admitting that the paper price you see quoted on your screen and the physical reality underneath that price have been moving in opposite directions for long enough that the gap between them has become structurally dangerous. Stay with me, because what follows is not a trade recommendation. It is a forensic examination of a setup that institutional participants are quietly watching while the public conversation remains fixed on interest rates and geopolitical headlines. And if you can read the architecture of what is actually being built here, you will understand something about this market that the dominant narrative is working very hard to prevent you from understanding. Let us begin with the number nobody is putting on television. The COMEX registered silver inventory, the physical metal sitting in exchange, approved warehouses carrying delivery warrants, the metal that actually backs the paper contracts traded daily in volumes that dwarf the available supply stands at approximately 79.8 million ounces. That number by itself sounds large enough to be reassuring. It is not. In April of 2020, that same registered pool held approximately 346 million ounces. In 5 years, the deliverable silver backing the entire COMEX futures complex has declined by roughly 77%. The paper volume has not declined. The contracts still trade. The promises are still made. Only the metal available to honor those promises has quietly, methodically, without a single press release or a single evening news segment, disappeared from the vaults at a pace that has no modern precedent. The coverage ratio, the fraction of outstanding paper claims that could actually be satisfied with registered physical metal, sits at approximately 13.4%. Exchange analysts who have spent careers watching this system describe readings below 15% as stress territory. The COMEX registered pool has been in stress territory for 7 consecutive delivery months, not 1 month of recovery, not 1 quarter where the trend reversed, 7 straight months of a number that should be alarming anyone watching it carefully, and which is receiving approximately 0 sustained attention from the institutions whose entire function is to watch it carefully. Now, layer onto that the demand picture, because the setup is not only a supply story. The consumption numbers do not resolve in silver's favor regardless of how the manufacturers run the arithmetic. Solar installation capacity grew 64% in the first half of 2025 compared to the prior year. Global electric vehicle sales ran 21% above prior year levels through the fall of 2025. The artificial intelligence infrastructure build-out has committed capital at a scale that was not modeled in any serious supply forecast written before 2024. Meta, Alphabet, Microsoft, and Amazon collectively committed more than $700 billion in capital expenditure for 2026, nearly double the prior year's figure. Every data center that capital commitment represents, every server rack, every conductor pathway in that infrastructure requires silver that does not return to the market. The metal goes in. It does not come out. And against that demand picture, mine supply growth has been essentially non-existent, despite a price environment that classical economics insists should have stimulated meaningful production increases. The reason it has not is structural rather than cyclical. Approximately 74% of global silver production is a byproduct of base metal mining, copper operations, lead operations, zinc operations where silver is extracted incidentally rather than as the primary economic objective. Silver's own price signals do not move base metal mine plans in any time frame that matters to the current supply picture. You cannot drill a new primary silver mine in response to a price signal and have that mine producing deliverable metal within the window where the demand exists. The timelines are measured in years, not quarters. And in the 6 consecutive years of structural deficit that the Silver Institute has now formally documented in its published record, the mining response that should have arrived has not arrived. The 762 million ounces of above-ground inventory consumed since 2021 did not regenerate. It was spent, and the structural conditions that spent it are not softening. If you are finding this framework useful, if this is the kind of structural examination that you cannot locate in the standard coverage, then subscribe now and turn on notifications. Because the data moving through this system in real time requires exactly this kind of structured observation, and the moments when that observation matters most are the moments when the mainstream narrative is most confidently pointing in the wrong direction. That is the first layer of the setup. Now understand what the second layer looks like. The silver lease rate is not a number that appears in most mainstream financial coverage. It does not generate headlines. It does not move retail sentiment. It is, however, one of the most precise instruments available for measuring the real-time scarcity of physical silver available for immediate delivery. Under normal market conditions, the 1-month silver lease rate sits somewhere between 0.3 and 0.5% annually. That is the cost of borrowing silver from the holders willing to lend it into the market. It is a number so small it barely registers. In late 2025, that rate moved from its quiet historical range to levels that analysts who track it described as the clearest possible signal the physical market can generate. Lease rates at 7, 8, 10% annually do not happen because traders are speculative. They happen because the remaining holders of unencumbered physical silver have looked at the available supply and decided that parting with their metal, even temporarily, carries a premium that reflects genuine scarcity. When the price of lending silver goes parabolic, the system is communicating something specific. It is communicating that the people who know exactly how much real silver exists and where it is sitting have concluded that the supply picture is considerably tighter than the paper price is suggesting. The lease rate is the physical market's own voice speaking over the noise of the derivatives complex. And that voice, in the window we are currently operating in, has been saying something the paper price has not yet fully absorbed. The third layer is geographic, and it is the one that eliminates the overflow valve the conventional analysis assumed would exist. For years, the implicit assumption underneath Western silver market modeling was that Chinese refining capacity served as the system's backstop. If North American and European processors ran into difficulty, Chinese facilities would absorb the displaced volume. That assumption was never tested seriously because it never had to be. It was simply embedded in the architecture of how analysts thought about global supply resilience. On January 1, 2026, that assumption was formally invalidated. China implemented silver export licensing requirements that effectively repositioned refined silver as a strategic resource rather than a freely traded global commodity. The overflow valve was not just partially closed, it was removed from the system entirely. Every industrial buyer in the United States and Europe who had been running mental supply chain models that included Chinese capacity as a fallback now competes for the same constrained physical pool as everyone else, with no backstop remaining. The geographic concentration of silver refining, which was always a theoretical vulnerability embedded in the system's design, became an operational reality the moment Beijing made that policy decision. And that decision has not been reversed. It has not softened. It has not been the subject of negotiation. It sits in the system as a permanent structural alteration, largely unaddressed by the mainstream coverage. Here is where the setup becomes specific and why the timing matters in a way that is worth sitting with carefully. The LBMA, the London Bullion Market Association, operates the largest physical silver clearing system in the world. Its LOCO London Vault Pool is the global benchmark. And in October of 2025, when delivery demand tightened against the physical supply available in that pool, An institution that had managed global silver clearing for decades briefly lost its footing in a way that left a mark on the institutional memory of every serious counterparty in the market. The one-month lease rate in London moved from approximately 1% to over 30% in a matter of weeks. Not over a quarter, not over a year. Weeks. The system caught a ledge. It climbed back. The pool did not refill. The structural conditions that produced the near fall remained intact, and the participants who watched it happen from inside the system changed how they manage their own positions in ways that are not publicly disclosed, but that show up in the delivery data and the warehouse reports if you know how to read them. Physical silver is being accumulated by actors whose behavior moves markets at a pace that is inconsistent with purely financial speculation and consistent with strategic procurement by entities that have concluded that the paper price will not remain an accurate reflection of physical availability indefinitely. The Shanghai Premium is the most visible public evidence of that conclusion. The Shanghai Futures Exchange has been carrying silver at a premium to international benchmark prices in the range of 12 to 17% in recent months. Under ordinary market conditions, that spread would not exist for more than hours. Arbitrageurs would purchase cheaper silver in the West, ship it to the higher-priced Asian market, and compress the difference into irrelevance. The premium persists because the metal that would close it cannot flow. Export restrictions, constrained inventories, and refinery disruptions have broken the arbitrage mechanism that normally keeps global silver prices coherent across geographies. When arbitrage breaks down, what you are observing is not a temporary inefficiency waiting for the next clever trader to correct it. You are observing evidence that the physical market has fractured into regional pools with genuinely different supply conditions, and that the unified global price the futures complex is supposed to represent has become, in measurable and verifiable ways, a fiction. A useful fiction for entities that trade paper. An increasingly dangerous fiction for entities that actually need the metal. The bear case deserves direct engagement rather than dismissal, because intellectual honesty requires it. Rising interest rates represent a genuine headwind for any asset that produces no yield. A stronger dollar reduces purchasing power for international buyers and mechanically suppresses dollar-priced commodity demand. The Federal Reserve's posture for the remainder of 2026 is genuinely uncertain in a way that creates real pressure on the non-yielding asset thesis. Solar manufacturers are actively engineering silver out of their panels. Longi Green Energy is commercializing copper paste back contact cells. ICO Solar has silver-free heterojunction cells moving into commercial volume. The substitution story is real. These are legitimate counterweights that a responsible observer acknowledges and weighs without softening them. Monetary tightening is not a minor headwind. It is a structural pressure that can extend a consolidation period longer than any structural supply argument alone can override. And yet, the entities whose business it is to find silver for industrial applications, the procurement desks running supply chain models for manufacturers that cannot substitute silver in aerospace, defense, semiconductor, and medical applications, are not operating in the quarterly time frame that drives most financial commentary. They are operating in planning cycles of 2 to 4 years, and what their models are showing them is a supply picture that does not resolve on any timeline consistent with the growth commitments their companies have already made publicly. You cannot redesign a semiconductor package to eliminate silver in a quarter. You cannot qualify a copper-based alternative in a defense supply chain in 2 years. The substitution that the bearish argument depends upon is real but slow. The supply constraint is real and accelerating. The mismatch between those two timelines is the structural heart of the setup. The 3 data points worth monitoring precisely and consistently, not as trading signals but as structural gauges, are these. First, the COMEX Registered Inventory Report, published daily by the CME Group, freely accessible to anyone willing to look at it. If that pool declines below 70 million ounces, the coverage ratio falls below 12%, and the arithmetic of what happens at the next significant delivery event becomes genuinely alarming, in a way it has not been even during the stress periods already experienced. Second, the Shanghai premium. Any movement outside the 12 to 17% band in either direction is a signal that the physical demand dynamic in the world's largest silver-consuming market is changing in a way that will eventually transmit to the paper price. Third, the global lease rate. It is not updated on a financial data terminal the way equity prices are, but when it moves toward or above 5%, the system is communicating scarcity in the clearest language available to it. These three numbers tell a more complete story about the real state of the silver market than the spot price quoted on any financial platform. The spot price is the final output of a system. These three numbers describe the health of the system that produces it. The setup. Nobody is talking about is not a price target. It is a structural configuration. It is the combination of a physical supply pool that has been draining without interruption for 6 consecutive years, a refining infrastructure that suffered a cascading financing failure beginning in late 2025 and has not recovered to prior capacity, a geographic concentration of remaining supply that has been formalized as a strategic restriction by the world's dominant processing nation, a demand profile driven by technology infrastructure build-out that does not respond to price signals in the short run, and a paper-to-physical leverage ratio on the world's primary pricing exchange that exchange analysts describe as stress territory after 7 consecutive months below the threshold. None of these conditions are new. Each of them has been building for years. What makes this moment specific is that they are all simultaneously present in the same market at the same time, in a configuration that the historical record of commodity markets does not afford many precedents for, and which the mainstream financial coverage has not yet found the format to explain to the audience that most needs to understand it. The comment section below is where this conversation gets better. Tell me which of the three monitoring points, the COMEX registered pool, the Shanghai premium, or the lease rate structure, you think carries the most weight in determining when the paper price and the physical reality are finally forced into the same room. The argument is in the publicly available data. Every source referenced here can be independently verified. Pull it yourself, check the numbers, and arrive at your own conclusion. That is the only version of this analysis that actually serves you. And remember, this is for education and discussion only, not personal financial advice. I am sharing a way to think through the history, the market, and the structural questions so that you can make your own decisions with your own money and your own risk tolerance fully in mind.